Analysing receivables. Receivables are a business's claim on the assets of another entity. The most common type of receivables is account receivable, which is the balance of money due to a firm for goods or services delivered or used, but not yet paid for by customers. Analysing a company's accounts receivables will help investors and managers gain a better sense of a company's overall financial health and liquidity. To analyse receivables, businesses can use various methods. These include horizontal analysis, vertical analysis, and receivables turnover ratio. Each allow the business to understand their receivables. Horizontal analysis compares account balances over 2 or more time periods. Horizontal analysis reveals a business's growth and financial position in comparison to competitors and unwraps spot trends and growth patterns. To perform horizontal analysis, the amount in comparison year is subtracted from the amount in the base year and multiplied by 100 to be represented as a percentage. Vertical analysis is a financial statement analysis where each item in the statement is shown in the percentage of base figures. Each item in the income statement is restated as a percentage of gross sales, and each item in the balance sheet as a percentage of total assets. It is calculated by dividing the individual item by the base amount and multiplying it by 100. This analysis alerts the company if costs of goods sold or other expenses appear too high when compared to sales. The receivables turnover ratio defines a business's effectiveness in collecting its receivables, measuring how well a business uses and manages the credit given out and how quickly the debt is collected. Generally, a higher ratio corresponds to effective collection of credit. The formula used to calculate this ratio is net credit sales divided by the average accounts receivables. This can then be expressed as the days in receivables ratio by dividing the receivables turnover ratio into 365 days, conveying, in days, how long it takes a company to generate and collect its receivables. Let's look at an example to tie this all together. Isabella Sweets is a store that sells candies and lollies. Recently, she has analysed her receivables using each method previously mentioned. Horizontal analysis was performed on 2 aspects of the income statements for Isabella Sweets. Gross income presented a 54% decrease, which is a significant fall compared to 2019, whereas the sales promotion expenses showed a 38.9% increase between the years. This demonstrates that the increase in promotion expense did not correspond to an increase in income. Vertical analysis was completed on the total expenses in 2019 and 2020. In 2019, it was found that the total expenses accounted for 13.36% of the total net sales. In 2020, the total expenses accounted for 14.03% of net sales. This showed a slight increase in the expenses, however not an alarming amount. Finally, the receivables turnover ratio was calculated, dividing the gross credit sales by the average receivables to get a ratio of 3.5. Transformed into the days in receivables ratio, it is found that Isabella Sweets takes about 106 days between selling an item and collecting the receivables.